Hello, everyone, and welcome to another episode in the Federal Home Loan Bank of Topeka video series. My name is Trent Meyer, and today we're going to be talking with you about liquidity and the importance of planning for the future now with regards to that. Joining me today is our Director of Strategic Planning and Member Solutions, as well as our resident liquidity planning expert, Mr. Kevin Parks. Kevin, thank you for joining us.
Good morning, Trent. Thank you, and it's a pleasure to be here.
So to get things kicked off today, I think we want to take a look at some liquidity ratios and the trends dating back to the financial crisis and what that looks like. In the graph here on your screen, you can see that in times of rising liquidity, it's subsequently typically followed by a period of reversion to the mean, lowering liquidity. And right now on this graph, you can see an expedited situation of where liquidity trends have been rising. And there should be some sort of reversion to the mean coming up. Kevin, with liquidity high and on the rise, why are we talking about it right now? And do you think there'll be a reversion to some sort of normal? And what might that normal look like going forward?
Well, Trent, it's a good question. Why talk about liquidity when everybody is faced with having tremendous amounts of excess liquidity on their balance sheets today? It's going to return to normal. The question is when and how soon. And then also, I think we have to consider that normal in the future may not be the same as what normal has been in the past. I think, it'll be a different form of normal. It's not going to be like it was before the pandemic. Social and economic life will probably change forever as a result, similar to what we saw after 9/11. And the experience going to the airport is entirely different than it was before, but that's the new normal. And I think we'll probably see something very similar to this resulting from the pandemic. When we get back to this new form of normal, it's probably going to depend on a number of things, including, how effective are the vaccinations that they're coming up with, natural immunity that people may acquire, the quality of the testing and the tracking processes, therapeutics, and just the public health response to this pandemic. So there's a lot of factors that are going to come into play, but I expect that we'll come to a new normal. And certainly I think we'll see that this period of excess liquidity will dissipate and we'll probably return back to what we historically have seen in the way of liquidity.
Yeah, absolutely. It seems like it could be, something a little bit new as far as normal goes and maybe a slow recovery back to that. But we are in agreement that should indeed happen. And one thing that you and your staff put together is actually a comparison of liquidity trends as it relates to loan and deposit growth. And so let's take a quick look at that graph and see how the growth in loan to deposits affects liquidity, at least from a past perspective. Of course, going forward, it could be a little different. So from this graph, the key takeaway for me is you can see that as loan demand falls off, as deposits tend to rise, we see that rise in liquidity. And that happened through the financial crisis, post-financial crisis, maybe in an extended period. And looking at where we're at now, we've kind of expedited that again. So can you speak to the current environment we're in as far as loan growth, deposit growth, and in a relationship to liquidity trends and what we might expect going forward?
Sure. Looking at the graph, obviously, loans this year have been driven almost entirely on the commercial side by the Paycheck Protection Program and the funds that your customers have received from that. And many of those customers have left those funds on deposit in their account, given the uncertainty around the forgiveness process and whether they'll be eligible for forgiveness. Certainly, we've seen deposits grow because of not only those PPP loan proceeds, but also proceeds from other lending activities, commercial customers drawing on lines of credit, things like that. But I think it's also being driven in part by mattress money, if you will. That's the money that consumers are putting aside and basically in the old days putting under their mattress when there are periods of uncertainty and they weren't sure what the future held. So I think that's driving deposits, certainly. And then, the other thing I would say that we've seen is that, consumer behavior is certainly different today than it was, 6 or 9 months ago. And that's a result of the uncertainty and the stress that's taking place in the economy and this high money anxiety, or HMA, as I like to refer to it, is keeping money liquid. People really don't care about rates right now. They just want to have access to their money, and so they're keeping money short. And from a banker's perspective, obviously that behavior is driving this excess liquidity on the balance sheet and causing margins to squeeze. So we're going to talk more about this in an upcoming liquidity webinar that we're going to host next month. But we're probably going to see that this behavior is going to continue to be different than what it was before. And another thing that has occurred from this pandemic is we forced everybody to go to technology channels, if you will, to do their banking and pretty much every other aspect of their life. And I think that's probably spurred this what has been kind of an evolution of banking and made it accelerate, if you will, to more technology channels. And I think that's going to introduce a new form of competition in the future for community banks as well. We have the advent of the online banks. Now we have, these huge money center banks and their tremendous investment they're making in technology. All of that's going to impact our business going forward.
Yeah, absolutely. I would agree with that. We've got a lot of different channels, and what that environment's going to look like could certainly be changing. And one thing I want to take a look at real quick, and as you mentioned, with the changes, the past may not be a complete predictor of the future, but this last graph to me is a little bit of icing on the cake. On this one, we look at the liquidity trends and where they've been moving in the last 14 years, and we have a correlation of that with what's happened with interest rates. And so, of course, as you see liquidity rise, interest rates tend to fall and vice versa. And that's just simple supply and demand, I believe. But as you saw us coming out of the financial crisis and liquidity rose, we saw a decline in interest rates. And then as you saw us recover from that, interest rates started to rise again and liquidity began to fall. So now we've got this rising liquidity environment. We're probably going to plateau at some time and maybe even revert back to some sort of mean. Does that mean that interest rates are then going to rise? And could you touch on how banks should plan for that going forward if that is going to be the case in some way, shape, or form?
Well, certainly, I think there's going to be higher interest rates at some point in our future. I think the question is when, but I think we all expect that to occur. As the economy recovers, certainly with the massive amounts of U.S. debt that's been issued, we're going to have to see an increase in rates to continue to support, that level of government debt in the future. But I would say that. Even though today is not a period where you're worried about liquidity, or most of our members are not worried about liquidity, it's better to plan from a position of strength than from a position of weakness. And so today is when I would suggest that people start thinking about the future. And when we revert back to more normal banking environment and interest rate environments, we should be thinking about, what our capital liquidity and funding plans will be in the future. We should be looking at what our funding sources will be and making sure that we have updated our inventory of retail, commercial, and wholesale funding, and that we're prepared and we know what those channels will be. We should look at our liquidity policy and our metrics that we have in our policy to make sure that those are appropriate as we think about this new normal as it may be in the future. So, what are the analytics and reporting tools that you're using? What are your liquidity gap measures at the 1 year and the cumulative gap positions? And what's your basic surplus plus picture look like? And then the other thing I would suggest you consider is these alternative measures of liquidity. While some of these aren't necessarily applicable to our community banks, I think there's still good measures to consider and be familiar with the concept around. And that's the LCR, liquidity coverage ratio, and then the NSFR, the net stable funding ratio, which is something that our regulators are just now enacting. Will take effect July 1st of 2021 for the money center banks, but there are going to be different aspects of the NSFR that are going to apply to different size organizations. And while they won't apply necessarily to our community banks, I think it's still good to understand the concepts. It provides you insight to what our regulators may be thinking and how they are looking at liquidity. So I think it's always good to be familiar, and now is the time to do that homework and get prepared for that future cycle. Something else that I would just comment on, I know that historically the loan to deposit or loan to share ratio has been something that our members use to help form decisions and establish, liquidity plans and positions. But I would challenge whether that's still appropriate in today's age. And we'll be issuing a white paper that we refer to as the fallacy of the loan to deposit ratio or share ratio in the near future. So I encourage you to read that when that comes out. And we'll touch more on that topic as well at our November liquidity webinar. And then the other thing I'd comment on is now's the time to be doing forecasting and stress testing and thinking about, how would you respond to the next crisis event that might come up, whether it's a pandemic or some other type of event, and make sure that you have appropriate contingency plans in place for that. So during our liquidity webinar, we're going to touch on a variety of these points, but plan from a position of strength, not weakness.
Yeah, absolutely. And that's the overarching theme of this video today. And certainly we've talked about the importance of that planning now. Kevin's alluded to some new ratios that you can look at from a liquidity planning standpoint. And I will say that white paper on the loan to deposit fallacy is very good, in depth and detailed. And so definitely take a look at that when it comes out. But we just touched the tip of the iceberg today. As Kevin alluded to, him and his staff will be putting on a webinar coming up to dive a little bit deeper into that, talk about some strategies and some tools you can use for liquidity planning purposes. So please stay tuned for that. I believe the first offering of that webinar is going to be on Tuesday, November 17th at 10 a.m. And there will be one the next day on the 18th at 2 p.m. as well. So 2 different options for you there. So please tune in if you have time. But good news is on those webinars as well, please take this into consideration, is that if you don't have all your CPE credits yet for the year and you're running a little bit behind, we are going to offer some on those too. So if you need some CPE credits, certainly tune in. But Kevin, man, thank you today for all of your insights that you have on liquidity planning. And I sure look forward to attending your webinar coming up and diving into these topics a little bit deeper. But thank you for taking the time with us today. Appreciate it.
Oh, Trent, thank you. It's a pleasure being here. And certainly, liquidity is something that drives our entire business. And so the more we understand it and the more we talk about it and we understand each other and what our plans and our operating guidance is, the more we can help each other. So it's been a pleasure being here today and look forward to talking more with our members at the upcoming webinar.
Absolutely. Thank you, Kevin. And everybody stay safe out there. And we look forward to seeing you at those webinars here in the next month or so.